Hello and welcome to another lecture of ACC Masters. In this video, we will start a new chapter related to capital loan. So, if we talk about borrowings, then the shareholders of the company usually try to impose some maximum limit on the directors of the company. For example, beyond that limit, the directors of the company cannot borrow any amount, especially in the case of public limited company or if the company is trading on stock exchange. But in case if the directors take money beyond that limit, then in that case it will be unenforceable, okay, and will be considered as ultra vires. However, in both cases, the lender will probably be able to enforce the contract if the contract is within the capacity of company but beyond the delegated powers of directors. Then in that case, the company can ratify the contract at later point. Personal guarantees. The lenders, such as banks, may require the directors of the company to pay out the loan out of their personal wealth in case if the company default. And it is usually common in the case of small company or a new company where there is no other source of fund available. The loan capitals are usually long-term borrowings of a company. By long-term we mean more than 1 year, for more than 1 year. It may include permanent overdrafts, okay, unsecured loans or loans secured on assets from banks or from third parties. Companies often issue long-term loans as capital in a form of debentures. Debentures. It is a document stating the terms on which the company has borrowed money. And there are three main types of it: a single debenture, debentures issued as a series, debenture stock, which requires debenture trust deed. And it is the important point: a debenture may be secured on some or all of the assets of the companies or its subsidiaries. And such type of loans is known as secured loans or charged over the company's assets. However, a document relating to an unsecured loan is also a debenture in company law. Debentures are transferable securities. Now we have three types of debentures. First of all, we will talk about a single debenture, a document which certifies the existence of a single loan. For example, in case if you take an overdraft from a bank, then a document which will certify its existence will be a debenture. Typically, it is secured against any assets of the company, and it usually specified a particular date at which the loan will be returned back to the debt owner. During that period, the company will provide interest to the debt owner. Now, in case if the company failed to provide the debt back to its debt owner, then in that case, the debt owner can sell the assets of the company and recover its amount. And any extra amount or the surplus amount will be paid back to the company. And the holder of debentures are creditors, not its member. And finally, a debenture carries no voting right at any meeting of the company. Secondly, debentures issued as a series and usually registered. Different lenders may provide different amounts on different dates to the company, although each transaction is a separate loan. The intention is that the lender should rank equally, which is known as pari passu, in their right to repayment and in any security given to them. So each lender therefore should receive a debenture in an identical form in respect of their loan. And finally, the third type is debenture stock. Only a public company may use this method to offer its debenture to the public. And let's say if the public company is a quoted company or a listed company, then in that case it must have to follow stock exchange listing rules. It is an important point. Unlike debenture debt, the debenture stock is a form of equity. So because it's a form of equity, so it put backs the debenture holders behind all the debts in the event of liquidation. When you buy stock, you may be one of the owner of the company. Okay, each lender has a right to be repaid their capital at the time due, and during that time the company will give an interest until the company repay to the debenture stockholder. The debenture stock operates almost identically to preferred stock or preferred shares. If we compare debentures with debenture stocks, then the debentures are more secure than debenture stocks because here the company guaranteed to pay back its capital and the debentures have higher interest rates. While the debenture stocks are for those who like to take higher risk for the sake of higher return. Debentures are for the people who want safe and secure income. Debenture stock must be created using debenture trust deed.